Ray Dalio is one of the most successful investors of all time and one of my favorite investors to follow when he does interviews on an ongoing basis to see what his opinions are on the current markets and how investors like you and me should be approaching our portfolios. And just a couple of weeks ago, Ray Dalio was on CNBC to talk about the current state of the markets and how investors should be thinking about diversifying and managing their investment portfolios given the current environment economically as well as politically. And he shared that clip of the interview on his YouTube channel, Bridgewater Associates YouTube channel, I should say. So today we're going to go through some of the most important clips in that video, and I'm going to break down some of the more complex issues so that they're easier for you to understand. I'm not going to go through everything that was in this interview. It went for about 20 minutes, so it wasn't that long anyway, but I'm going to focus on some of the more important parts. So if you want to check out the full interview, I'll leave it linked down in the description below and you can check it out after this video. But today I'm going to provide some commentary, my opinion, as well as some deeper explanations on some of the most important parts from this interview. So without further ado, if you do get some value out of this video and do want to see more content like this in the future, then please hit that like button and consider hitting that subscribe button so that you can stay up to date with all of the content that I post on my channel. But with that said, let's jump into the video. Right at the beginning of the interview, Ray Dalio talks about how the current economic environment is being influenced really by three key forces: debt, wealth inequality, and a rising power in China.
Well, I think it depends on the time frame, and I think the relevant time frame is the next few years. And I think you have to put things in the context. So there are three big forces that have been at work, and I think you have to understand those. First is the debt money thing. How much debt and money, and what are the repercussions? How does that pass through the economy? What does that mean for markets, inflation, and so on? We're in a different era now. Zero interest rates, produce a lot of debt and monetize it. Second influence, the conflict, internal conflict over wealth, left-right conflict, that conflict. And then the third is the rising of a great power in the form of China, challenging an existing great power and challenging the existing world order. Those three things are coming together at the same time as then we have a pandemic.
Debt in the United States, but also across the world, is a major factor influencing economic conditions right now, because across the world there are many places which have near zero or zero interest rates, and the result of cheap lending is that personal, business, and government debt has gone through the roof. And as a flow-on effect of some of the monetary policy that's been going on for over a decade now, there has been increasing internal conflict in the United States, but also across many other countries as well, particularly in regards to wealth inequality, which is rising, and other areas of politics. And then the third factor is this rising power in China. China is more and more becoming a capitalist society that is becoming a massive economic machine and bringing their middle class out of poverty. And as a result, they are contending with the United States, which has a much smaller population, but has been the leading power economically for such a long time.
I think each one of those is a cycle. What's happening now has not happened before in our lifetimes, but has happened in the 1930 to 45 period. I went back and studied it over 500 years. And so it's that context.
He goes on to explain that each of these forces are cyclical, but they happen cyclically over an extremely long period of time. So you have cyclical businesses that might go through a 5-year cycle or a 10-year cycle or a 20-year cycle. For these forces in particular, they have 50 to 100-year cycles. So for your lifetime, it may not even look like these things are going through cycles. It may look like they're only heading in one direction, but if you zoom out and look at the history, and Ray Dalio has been looking at 500 years of economic history, then you can start to see these cycles change over time. And he actually thinks the conditions that we're seeing for these three forces right now are extremely similar to the 1930-1940 period. So then throughout the interview, Dalio goes on to explain in detail the three key forces. And we're not going to talk about all of them, but we'll focus on a couple that I think are really important to understand.
There's not enough money to go around, right? We're spending a lot more than we're earning, and we have to do that partially because of this social redistribution, that necessity, and they can't take it all from taxes. And what that means is the printing of money. So it's the mechanics of that. So what you do is you get more money, and so that devalues the value of money. In other words,
Right.
cash is trash.
Dalio starts by talking about debt, and he explains that as it is currently right now, on a personal level, on a business level, and on a government level, we are spending far more than we are producing, right? We are spending more than we're producing, and the way that we're doing that is by using debt to fund that excess spending. And while household and business debt is of course a concern, the largest spender out of those three categories is of course the government. So it's important to understand how that's possible, how that works, and what are the impacts of that. So when it comes to the government at the moment, and for most times over history as well, but particularly right now, considering we're going through a pandemic and there is a need for stimulus, the government is spending far more money than they are bringing in from tax revenue. And the result of that is that they need to take on debt in order to finance that excess spending. So how that looks for the government is they issue government bonds, and some of those bonds are purchased by the public. They're purchased by investment funds or individuals or maybe even people overseas, and that's how they're able to finance their excess spending. But in times where excess spending is really, really high, and at the same time, interest rates on those government bonds are really unattractive. So right now they're about 1% for a 10-year bond or 1.5% or something like that. When that is the case, the Federal Reserve needs to step in and fill that demand gap because there's nobody willing to buy those extra bonds at really low interest rates. The Federal Reserve prints a bunch of money and buys those bonds. And what that really means is that there's more dollars in the system, and the result of that is that each dollar is worth less than it was before. Think of it this way. If I printed a bunch of money, if I was the Federal Reserve and I print a bunch of money and I give everyone $1 million and say, hey, everyone can go and buy a house now. There's no issues, right? Well, can't everyone just go out and then just buy a house, right? Well, no, because everyone showing up to the auctions will also have an extra $1 million, which means that prices will simply be bid up higher. So simply adding more money to the system, printing more money, does not make people more wealthy. It actually just devalues each dollar. It makes things more expensive, right? And we measure that through the consumer price index, and we measure that with a measure called inflation.
In other words,
Right.
cash is trash.
You came on our air, I think, in Davos and said cash is trash. You still believe it?
Of course you don't. Look, this is guaranteed. You are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether
Right.
it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic, right?
Dalio then goes on to say that because of this, cash is trash. And he's right. Currently, if you have a lot of money in a savings account, you're earning very, very little interest. And beyond the fact that you're earning very, very little interest, we have, at least right now, considerable inflation. So inflation is outpacing the rate that your money is growing in a savings account, meaning that it's being devalued over time. And what that means essentially is that you need to be putting your money into other assets that produce a higher excess return than your savings account or government bonds, for example. And that means putting money into the stock market, into property, or into other asset classes. But Dalio is actually very clear here that just because cash is trash, it doesn't mean that he thinks there will be good returns in stocks and property.
So that suggests to me two things. Somewhat bullish, therefore, on the markets, I would think.
That's right. On the margin, so if we look at the expected return of equities, let's say U.S. equities and so on, and you do the projections of present value of discounted cash flows type of thing, you probably can have somewhere in the vicinity of 3.5 or 4% return, and you probably can get, so return relative to the return of cash, it's a better deal. But those, as equity prices go up, those excess returns go down. That's what produces more of bubble, in other words,
Right.
the lower returns there. And as that shrinks, and then if you should have rates to rise, that cushion narrows. And as that cushion narrows, you come into more and more danger.
Right.
He does think that stocks will do better than cash. In fact, he says that every asset class will pretty much do better than cash, but that stocks from here probably have an expected return of 3 to 4% per year, which is terrible compared to historical standards. So there's really two things going on here. On one hand, cash is so bad that stocks look good at almost any price, right? A 3 to 4% return in the stock market is historically very bad, but it's better than the negative real return that you're probably going to experience if you just hold cash. And the other thing that's going on is because cash is so bad and stocks look good at any price, stock prices are moving into bubble territory. People are willing to pay any price for a stock, and that puts stock prices in a very, very sensitive position. Think of it this way. If the stock market is offering you a 3 to 4% return, and currently your savings account is offering you 1%, then maybe it makes sense for you to invest most of your money in the stock market so that you can make an excess return of 2 to 3% on your portfolio. But what happens when interest rates start to rise and the savings account interest rate goes from 1% to 2.5%? Are you still willing to put your money in risky businesses for a 3% return in the stock market if you can get 2.5% on a risk-free government bond or in a savings account that is very much virtually risk-free? And at that point, people will start to pull money out of stocks, in other words, demand a higher return on those stocks, and the result could be very, very devastating for the stock market, which is why it's in such a fragile position currently. Of course, in this video, I don't want to just include the theory about what is going on right now, but also what Ray Dalio thinks you should be doing with your portfolio and how that compares to my approach so that you can get an idea of how I'm approaching things based on Warren Buffett's key investing principles and what a macroeconomist like Ray Dalio thinks you should be doing with your portfolio.
First, no, cash is trash. So don't keep it in cash, right? Second, the most important thing I think that an individual investor or any investor could do is know how to diversify well, because all those asset classes will outperform cash. And so if you, but also risk, when you can diversify well, and when I mean diversify across countries,
right,
currencies, asset classes, and so on, so that you have that balance. Then you take your tactical moves from there. But the most important thing, I think, is to know how to diversify well.
Essentially, Ray Dalio says what he's been saying for many, many years now, which is that as an individual, as a regular person, you should be trying to have a really, really well-diversified portfolio, meaning having money in different asset classes, stocks, bonds, commodities, other asset classes, across different countries, across different currencies. So having as much diversification as possible. He even includes crypto in that. He now has a very small percentage of his portfolio invested in Bitcoin, and he says it is a smaller percentage than his gold position, which is a smaller position than his investments in stocks. So a very, very small amount, but he does now diversify into cryptocurrency. Personally, this is where I diverge from Ray Dalio. I like listening to Ray Dalio for a lot of his theory about how the economic machine works, but when it comes to investing, I like to invest in things that I understand, and I like to avoid things that I don't understand, particularly assets that are non-cash producing assets. So things like commodities, gold, and cryptocurrencies. And while I do agree that cash is trash and is being devalued, so you don't want to hold on to a large amount of cash over the long term, I can also see that the stock market is in an extremely delicate position because of interest rates being low for so long, and the result being the stock market is moving significantly into bubble territory, low expected returns, and that could easily flip very quickly if interest rates do rise. And while I have no idea if or when a crash is coming for the stock market. That is certainly not what I'm trying to time. I like to hold cash in the short term and look for individual investment opportunities in this fragile market that does send great business stock prices down considerably, 50, 60, 70% in the short term if they're going through some kind of short-term problem. So instead of being widely diversified and always fully invested, I like to hold cash and wait for the unique opportunities, which for me has tended to come around about once per year when I find a really good individual stock opportunity, wait for those opportunities and invest significantly into them. And that does mean that I do hold cash in the short term, but for the vast majority of the time, I am mostly invested in the stock market and have benefited from the considerable run-up that has happened while cash is being devalued. So that's my opinion. That's Ray Dalio's opinion and also his theory on what is happening in the markets right now. I hope you guys got some value out of this video, and I'd love to hear your thoughts down in the comment section below. But if you did get some value, I would very much appreciate it if you take the 2 seconds to leave a like on the video and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, I hope you guys have a great day, and I'll see you in the next video.